Hello, and welcome to another of the Nautical Institute's technical webinars. I am David Petraco, and I am with the Nautical Institute London headquarters staff, so welcome. I'm also pleased this afternoon to welcome Captains Varma and Captain Singh. Good afternoon, gentlemen.
Good afternoon,
Good
David.
afternoon.
Okay, I will introduce them more fully in a little bit, but before we do that, I'd just like to I'm assuming that most of you are familiar with the Nautical Institute, but if you're not, I'll just say that we are an international professional body. Our main role is to help our members in their professional development. We also represent our members at various international forums such as the IMO and IALA. And one of our main roles is to share information to help us develop ourselves cooperatively and also to establish best practices. And the reason we do this is because we feel that people who continually update themselves, continually learn, act as professionals, make better decisions. And those better decisions are not always to do with perhaps safety. Some of those are to do with commercial operations, career progressions, anything professional, they make better decisions. So that's why we do it. And can a better knowledge of commercial trends and challenges help you make better decisions? Well, we certainly think so, and we welcome Captain Singh here today to help us understand how that can be. But before we start, this is an interactive webinar. Your microphones and your cameras will not work, but you will be able to type a question. So you have a little control panel. If you click on the white arrow in the orange field, it expands. And once it's expanded, you'll see a place for questions. Type in your question. Don't forget to press the little send button, and I will get those questions. After the webinar, you will be presented with a very short survey, 2 to 3 minutes, asking you how we did, and we welcome your comments because that helps us continually improve our performance. About 2 to 3 hours after the webinar ends, you will get a thank you email saying thank you for attending, and there will be a link to a personalized certificate with your name on it. Feel free to download that or whatever you'd like to do. This webinar is being recorded, and the recording will be posted on our YouTube channel probably by the end of tomorrow. So feel free to share that with your friends and colleagues. And you are not alone. There are about 350 people registered for this event. So when you do write in your question, if you could keep it succinct as possible, it will help us sort through them. So now it is my great pleasure to introduce Captain Manish Varma, our training manager at the Nautical Institute. Manish has had many years at sea and many years ashore in the training sector, and yet he still looks young and dashing. Go figure. So, Captain Varma, could you please introduce our guest speaker, Captain Singh? Thank you very much.
Thanks, David. Thanks, Captain Singh, for agreeing to do this webinar for us. To introduce Captain Amrit Singh, Captain Singh is a lead shipping analyst at Refinitiv in London. He has over 30 years of shipping experience and got his command with Will Williamson, Norway, before stepping ashore. Prior to joining Refinitiv, formerly Thomson Reuters, he was senior equity analyst at Clarkson's Capital Markets in London, and he has held position as general manager of a shipping agency and has served as head of corporate planning in a shipping company. Captain Singh holds a Master of Business Administration degree from University of Edinburgh, Business School, UK, beside a diploma in ship management from NSTC at Northwest Kent College, UK. He also qualified as a lead auditor in quality and environmental management systems. Thank you for joining us, Captain Singh. I would like to invite you to give your presentation.
Thank you, Captain Manish, and thank you to the Nautical Institute. I'm delighted to be joining you and all the other attendees. It's a pleasure. So hello, everyone. As Captain Verma introduced, my name is Captain Amrit Singh. Just a bit of background of what I've been doing at Refinitiv, where I am currently. I co-founded the shipping team about 7 years ago with the mission, which is simplifying shipping. And what we do is that here we place our users at the helm of decision making by using powerful tools and modern technology, which you would have heard of, like artificial intelligence or machine learning. And we enable our users to visualize, analyze, and act upon content in real time, and which is what I think allows people in shipping to make good decisions. So first of all, let me kick off by sharing a map of what we see in our system. The ships around the world, like the green are the bulk carriers, the light blue ones are the container carriers. And I would like to pay tribute to our fellow seafarers who are in these tough times, keeping the flow of food, energy, medicines, and essential goods moving. It's a great work. We know of issues with crew changes, but the more that we make people aware of what our fellow seafarers are doing, the more it is good for the industry as a whole. Next, what I'm going to run through is discuss shipping, which I consider a tale of two halves, which is the first early part of the year with the pandemic, it turned differently, and then after the pandemic is still continuing, but things have improved in certain areas. So we look at the ton miles demand and the supply chain congestion. We look at the volatility of the freight rates. We look at the shipping regulations in play, like the ballast water management and the IMO 2020, which brought in the sulfur cap. We'll also briefly look at the shipping decarbonization plan, have a view on what is the fleet growth looking ahead for this year and next year, and what I call the 4D challenges of shipping, which I think we'll have to grapple for the next 1 or 2 decades. Now, looking at the Capesize ton-mile demand. Ton-mile demand is simply the number of tons of cargo carried over the miles which is carried. And we have systems in place to compute it almost on a daily basis. When you look at the Capesize, and the dotted green line is the one for this year, when I look at the first 9 months of this year, the ton-mile demand, when we started from January to mid-February, dropped significantly, almost about 15%. And then post-June, it has increased by about 11%. For the first 9 months of this year, the ton-mile demand for the Capesize has been increasing by about 1.5% when we compare with the previous year's 9 months period. Now, what is good about this ton-mile demand is that it very clearly signals the disruption in the supply chain. And this disruption could be because of any incidents, like if we look at the last year's ton-mile demand, which is in red, which had fallen, it was the unfortunate incident that had happened at Vale, who is one of the major iron ore producers in Brazil, with the bursting of the dam. And it dropped significantly. But when Vale's production after a few months came online, it increased. So ton-mile demand, as I said earlier, is a very good indicator of where the shipping industry is headed. Now, looking at the VLCC one, the picture is different than the Capesize one. On the VLCC one, as we all know, there are sanctions on Iran, which were implemented, and more recently on Venezuela. So what that means is that the supply from Iran and Venezuela has dried up, and that means shipping has to go further afar to move the cargo. What we also see is that there is an ongoing trade war between China and America. And though they have reached phase 1 agreement, not all, what has been agreed to, we do not see all the cargo or all, the dollar value that we agreed to being implemented. And then what we saw early part of this year on the tanker sector was the price war, which happened with the OPEC Plus, and the two of the partners, Russia and Saudi Arabia, continued to supply oil in the market when the demand collapsed due to coronavirus. And that led to prices falling, but more supply as well. And what the dotted line shows is that initially, when that happened, there was a demand for VLCCs going up, and the demand for VLCCs went up because the shore storage was filled up, and then the traders shifted to the floating storage, and that's where VLCCs came in helpful. But once the oil prices have started to recover post May, June, what we see is the unwinding of the floating storage, and the demand has not come back to the same level because the continent across the globe are still having impact of pandemic being felt. So that's why we see a steep drop in the VLCC ton-mile demand when we look at the September figure. Now, in terms of shipping, shipping is very demand-oriented. So when we look at the dry bulk, looking at the iron ore flows, what you see in solid lines are the exporting countries, Australia and Brazil. What you see in dotted lines are the importing countries. And it's needless to say that China is the main demand driver for iron ore as well. So what we see in the early part of this year is that because of the COVID-19 impact, when it started off in the Far East, you have a drop because there were lockdowns, and then slowly the demand ramps up. When we look at the exporters as Brazil, what Brazil witnessed last year, as I mentioned, if you look at April 2019, there is a blip that is because of the dam disaster that happened, but the early part of the year in Brazil, we had heavy rains which damaged infrastructure. And because of that, there was less cargo moved out from Brazil. But slowly, as time has gone by, Brazil has ramped up production. So, you can see that the iron ore that is being imported by China has seen a growth again, which is the dotted line on the top. So China's iron ore demand has staged a strong recovery. And this is driven by the stimulus measures which have been introduced after COVID. And this has led to higher steel production as well. And another reason for higher steel production is that previously China used to use blast furnaces, but due to pollution reasons, they have then switched to electric arc furnaces and buying scrap steel. And that helps in environmental concerns, and that helps in increasing the efficiency of the steel production as well. So that's the story on the iron ore flows. Now, in this slide, we look at another great commodity that moves on the dry bulk ships, which is the coal. Now, coal again, Australia, Indonesia, and South Africa, which you see in solid lines, are the major exporters, while in dotted lines, it's Japan, South Korea, and China, the main importers. Again, this is the story of China importing coal continuously. However, what we see this year is that during January and February, you see a dip, which was, of course, it was because of the pandemic, but also due to environmental concerns. China has restricted the amount of coal to about 300 million tons per year to be imported into the country. And that's the reason that we see that slowly the amount that is being imported into China is gradually decreasing. Australia has been a key exporter as well, but as you would know that there are some geopolitical tensions which are taking place between Australia and China. So for the recent months, we see some decline in coal imports into China from Australia. However, having said that, if you look at the South African exports, which is the line right at the bottom of the chart, that has started growing. So it is sourcing more from South Africa now. Now, continuing with the dry bulk, we've discussed the major commodities, iron ore and coal. Soybean is one of the grains which is carried on Panamax and Handymax bulkers. And what we see again here is that Brazil, which is represented by a solid orange line, has had a record soybean export. And with the record soybean export out from Brazil, we see most of the imports are into China or into Asia, and the Chinese imports have increased as well. On the other hand, America, US, when the Brazil season ends sometime by the end of September, the American grain season starts off. So we see the American soybean exports going up. Now, I mentioned earlier about the trade war and the phase one agreement that has been reached between China and the US. And within the phase one agreement, they do see movement of soybean from US into China. But again, the demand within China has been dampened by the African swine flu fever that was there, and that continues to dampen the demand within China. So the expectation is that given that China has been importing so much and the demand is still damp within China itself, our expectation is that soybean is being stockpiled as well. Now, looking at crude oil flows, again, the solid lines are the exporting countries and the dotted line is the importing. And when we look at exports out of Saudi Arabia early in the year, because there was a price war going, you can see a steep rise in the oil being sent out. And at the same time, if you see the dotted line for China on the top, China continued to import, and that was because the oil price had fallen. So the oil was cheap, and then oil can be stored as well. So our expectation is that some of this oil went into storage, strategic reserves as well. So at the same time, Iran, the sanctions that were put on Iran, and you could look at the bottommost line, which is the Iranian exports. Because of the sanctions, the Iranian exports have been declining. However, when you look at the US exports, they have replaced the Iranian exports. So what we see is that US is sending more and more, exporting more, and some of this oil is finding its home into China, and US is sending out shale oil as well. What is not known is that how much of this will contribute towards the phase one agreement, because there was a dollar value attached to the phase one agreement, but with the oil price falling, the phase one amount is difficult to be reached. Plus, with the elections looming, one has to see how geopolitics will play a part as to, who's going to come into the White House next. But the key thing is that when we look at, across the major dry bulk commodities, China's recovery has been strong across dry bulk and crude as well. Now, we spoke about, the demand side of things. How does it impact the ships? So when we look at, congestion, and I have given an example for the dry bulkers on the left-hand side and Huanghua anchorage. We saw dry bulkers, having record congestion in September, October. And as I mentioned, because of China's strong recovery, you can see that. The similar trend followed on the tanker side, which you see on the right side of the graph. Tankers also across, and this is just an example of Qingdao anchorage, but across China, there has been congestion. And because there were more imports, more ships bringing cargoes in. So both the congestion and waiting times increased significantly as China recovered strongly. Let's look at the container side now. So, US West Coast is a good demand driver for how the container trade is going. So if we see at Los Angeles, which is there on the graph now, across the early parts of this year, we see a sharp decline in the inbound container volume. However, as months passed, from May onwards, we see a strong recovery in those volumes. And the same applies to another port, Long Beach in the US as well. So the story is similar. So when the pandemic hit the Americas, businesses responded by canceling their orders initially, and that resulted in the huge decline in volumes that you see. Now, the restocking has begun. And because of that restocking, we see the volumes increasing again. And we do not expect this to keep continuing. Also, with the festive season looming, with Christmas a few months away, there is some restocking for the festive season as well. Now, we looked at that now, in terms of the flows. How has it panned out for the earnings for the shipping sector? So what we have on the screen now is the bulker earnings. If we see for this year, for the Capesize, initially the rates dropped in January. But once the strong recovery of the iron ore and coal trade took hold, the rates have gone up to $34,000 a day and even increased to $35,000 a day. And if you just look back slightly to the previous year, which is the peak that you see in the previous year, that peak was of what I mentioned, that initially Vale had a dam disaster and the rates completely dropped around last year, April, May. And then when Brazilian production came back online, the rates went up to $37,000 a day. So there has been quite a bit of volatility in the market, because of various incidents that happen across in different geographies. And talking of the other sectors, the Panamax and Supramax, the larger ship sizes typically lead. And when the largest rates increase, there is a pulling effect which happens on the smaller ships, and you see their rates increasing as well. And the tanker story is remarkably different. So when the pandemic started, initially the tankers peaked because there was a huge demand for floating storage, but then the trend has started reversing. So looking at the right-hand side, when Russia and Saudi Arabia were pumping in so much of oil, there was a huge demand for VLCCs. And at one stage, Saudi Arabia went and fixed multiple ships for sending oil across to the US. And we saw rates touching almost $265,000 a day, which is huge. But as the oil prices recovered and the floating storage has started unwinding, what we see is that the tanker side has seen more drop in the price now. So, the market has been volatile, but it has seen some good periods. And what the tanker market initially saw at the start of the year as high earnings, those earnings are near to break-even levels or slightly above break-even levels. And on the container side, things are slightly different. So what we see on this chart is the top chart, the top line shows the China to the US West Coast freight trade, which is in FEUs, which is 40 equivalent units in US dollars. We see almost a doubling up of the freight rates. And from the earlier chart that we saw, we saw a huge increase in the inbound container volume, and that has led to that steep increase. Having said that, on a global level, and this is the Freightos Global Baltic Index, we still see almost 50% increase across the globe. And container trade within Asia has also been strong, so intra-Asia trade has remained strong. Now, when the pandemic initially hit, the container lines held their rates very well. They held them by blanking sailings. So blank sailings are, port calls being canceled. What the container lines also did was they returned the ships back to the owners. So, the owners had to bear the brunt of the pandemic in a way by, them not being able to redeploy their ships, or if they were able to redeploy, that was at a much lower rate because the demand had suddenly fallen. What also led to that was a huge idling of the container ships. So, the container lines manage capacity in various ways, so they idled container ships as well. So we have seen record idling of the container ships, almost about 2.5 million TEUs being idled up. And another, technique that is used in capacity management, and you see the graph on the right-hand side, is by adjusting the speed. And this graph is the speed of, the container ship fleet for anything more than 8,000 TEUs. And we see that from the January to the late April period, the speed almost declined by a little over 1 knot. And as and when the industry has recovered, the speed is back up again, which is represented in the blue line in the graph. So, the shipping, or rather the container sector, has managed capacity very well by optimizing speed, by blanking sailings, by returning vessels, and the sector is on a recovery path. But having said that, as we come towards the year end, we expect some dampening of this to happen. Now, we spoke about falling oil price. So here is a chart which shows WTI, which is the oil price West Texas Intermediate. And what we saw in a very, very long time in, sort of April, where the price fell into negative territory. And obviously, this was as the result of the demand falling. This was the result of full shore storage, and also as a result of some of the contracts that were being unwound. And we can discuss this later, but it has been like oil price, you are paying to store oil rather than the other way around. And all this fall in oil price has led to a huge increase in the floating storage. And we call this as, as a result of the contango. And contango is when the forward oil prices are much higher than the lower oil prices. But what we saw in this particular case, because of the pandemic, we saw a situation of what we call super contango, whereby the future oil prices were significantly higher than the current oil prices, which led to a huge demand. And that's what you saw earlier in the earnings of the tankers for floating storage. So almost about 225 million barrels of crude was in floating storage, which started unwinding in sometimes June, and you see that line dropping. Having said that, the same effect was seen on the product side as well, on the refined product side as well, which you see in the blue line under the dirty products chart. So they also saw almost about 90 million barrels of refined products confined to floating storage. And the reason for that was that obviously the demand has collapsed. People, countries were in lockdown mode. People were not able to use transport. The airline travel had fallen. So, things like jet, things like diesel, things like kerosene, they all come under, the clean refined products. And that's where we saw the floating storage increase as well, because there was so much of demand for the shore storage that it spilled over to the floating storage, and that helps the shipping sector. Having said that, when it starts unwinding, that obviously is going to create some negative impact. Moving on, we saw the volatility in the earnings. What we have here is in blue the Baltic VLCC TD3 route, which is Middle East Gulf to China. And this has been pretty volatile. And what I have also plotted it against is DHT Holdings, which is a shipping company in US with their share price in US dollars, and Frontline, which is an Oslo listed company. Their share price is in Norwegian kroners, but I have converted it into US dollars to depict on this graph here. And what you can see is that it is very highly correlated. So as and when the freight rates increase, the share price of those companies which are heavily involved in the tanker sector have responded in the same manner. So when there is volatility, if there is obviously a risk, but then there are returns which come out of volatility. And another example which I show on the right-hand side is in blue, we have the freight forward agreements, and this is for the same route, TD3C, which I mentioned earlier for the VLCCs, but it is for the forward month in US dollars per ton. And we compare it with a very popular Standard & Poor's 500 indices. And what we see is that because of what was happening on the tanker market, whilst the tanker earnings were volatile and they were increasing, because of the impact of the pandemic, the S&P, which tracks the wider sector, S&P had fallen down. So actually, if somebody had invested in S&P 500 and rather come out of it and invested into the GFI or the freight forward, or what the freight forward, which are actually financial instruments, they would have been better returns compared to staying in S&P 500. So, shipping stocks are, prone to volatility. And then, as I mentioned earlier, that if a person is having a good knowledge of the market, one can look at returns coming out of this volatility. Now, we've spoken of the commercial side. As you know, shipping is very regulation intensive. So here is just to show a sort of timeline as to the regulations that shipping industry is currently grappling with. We have the ballast water management, which started off in 2017, but for the existing ships, it has a time period till 2024. And by that time, by 8th September, all the ships have to comply with ballast water management regulations. In terms of the numbers that have been put out, it's approximately close to an $80 billion investment over this whole period, which is quite a substantial investment that the shipping industry has to put in. And given that there is impact from the pandemic as well, it doesn't make things easier. Then what we saw at the beginning of this year was the IMO 2020 regulation, which is the cap on the fuel oil for 0.5% sulfur. And what this meant was that the choices were limited to a few things. So one was to use low sulfur fuel oil. The second was to install scrubbers. So scrubbers, as you would probably know, are devices which are installed on ships to take care of this. And the various type of scrubbers are open loop scrubbers, which use seawater for cleaning purposes, closed loop scrubbers, which use caustic soda, and then you have the hybrid scrubbers. And the other alternative for the industry was to look at alternate fuels, and alternate fuels could be things like LNG, it could be things like methanol or ammonia. And initially, when we look at a little before these regulations were going to be implemented at the start of this year, people were very concerned about the availability of the VLSFO. They were very concerned about the quality. But the pandemic has changed everything. And on the next slide, we'll see how that has changed. So this chart shows how the very low sulfur fuel oil price was from last year till now. And what we see is that as we came close to January, and I've plotted a very low sulfur fuel oil on top, and the high sulfur fuel oil is on orange. At the start of January, when the regulations were being implemented, the price had reached almost to $750 a ton. And the spread, or rather the difference between the heavy sulfur fuel oil and the very low sulfur fuel oil was almost $370 a ton. But as the pandemic struck, things changed completely. There was a fall in demand for the oil because countries went into lockdown, and that saw a decline in the oil price, and that led to a steep fall in the difference. So what we see now is the spread of just about 40 to 50, or rather $50 to $60 between these two. Now, when we look a little forward, and here, what is the forward curve for the fuel oil for FO380 at Singapore and the low sulfur fuel oil? If you see, the spread is slightly widening as we go into 2022. So, if somebody has had scrubbers, it's worth a think, and we've seen some of them delaying scrubber installations, some of them having a rethink. So, this pandemic, because of the drop in demand of the, middle distillates like jet, etc., has changed the whole scenario, and refiners are able to produce low-cost blends of VLSFOs. Now, talking of decarbonization, this is an effort to reduce greenhouse gas emissions, and IMO has got a very aggressive agenda. So starting by 2023, which is the phase one, they would like to finalize the short-term measures And recently, I think last week, there was a meeting whereby they've agreed some more technical and operational measures, like the energy efficiency existing ship index and the carbon intensity indicator. And as we go forward, 2020, I would like to see a 40% reduction in CO2 emissions. So currently, how they stand as per the last report, the CO2 emissions from the shipping industry is about 2.9% globally. But if nothing is done, it's going to keep on increasing. So, they would want to reduce it by 2030 by 40%, 2050, the decarbonization 50%, and beyond 2050 to phase out greenhouse gas emissions completely. And this requires a huge investment because you're doing away with the fossil fuels. One has to look at what fuel is going to be efficient for the future, and also the cost factor. And there are estimates of almost about $1 trillion investment. Most of it is in the infrastructure, but still it's a huge amount of investment which the industry has to look at. Now, in all this, one has to look at how is the fleet sort of panning out when we look at this year and next with all the regulations, with the current supply and demand scenario. So what we see this year is that in terms of bulker deliveries and demolitions have been high despite the initial constraints, but the contracting, the new order book has been falling. So we see the bulkers fleet growth declining to about 2.9% this year, and a slight increase next year. On the tanker side, there has been a strong fleet growth, but very less demolitions, because the freight rates were high. And though we expect with the unwinding of the floating storage, the demolitions will increase. However, we still see fleet growing at about 3%. And we see the order book shrinking as well. And across sectors, the order book is shrinking because the owners are unsure for shipping, in the sense that we will see a low fleet growth when the demand is still uncertain and as the pandemic is still continuing across. Having said that, when we look at next year, we see across all sectors, whether it's containers or tankers, the demand growth being subdued. What we saw this year on the container side was that even ships as young as 15 years old were sent for demolition. So, the whole scenario this year has had impact on the shipping sector quite widely. Where does this lead us? This is, a chart of world trade volumes of goods and services. And, we see headwinds for shipping, and we see headwinds because of, the trade war continuing, the sanctions across, be it Iran, be it Venezuela. The OPEC Plus is not decided. What we also see is now suddenly Libya is ramping up production. So, they expect within a few weeks to months to go to 1 million barrels per day production. That means there will be more oil into the market, which is not good in a low demand scenario. So OPEC Plus will have to take further decisions on the quotas, and with the pandemic raging on. So this year, in terms of shipping, is expected to have quite a bit of headwinds. Finally, we look at the challenges that are facing shipping. So I call it the 4D challenges. And the first one is the decarbonization. And, as we spoke earlier, climate change is the key driver for this. And, we want to shift away from fossil fuel, but at the same time, we have to see which fuel is really efficient for the shipping industry. How it stands so far, LNG is as a dual fuel. LNG is finding favor. The second option is, where ships can do short distances. There are battery options available. There are other fuels like biofuel or methanol or ammonia being tried out. So this is, the next 1 or 2 decades is what shipping will have to look at huge amount of innovation as to which is going to be the most efficient fuel, because we've done it before and I'm sure we'll do it again, because first it was the steamships which were powered by coal, and then came fuel oil. And after fuel oil, whether we go the LNG way or the solar way or the wind or the battery way, that has to be seen. So decarbonization is the challenge which shipping has to contend with in the coming years. The next one is digitalization. And as we know, many processes within shipping are analog, and there is opportunity to digitalize. And the pandemic has hastened that pace. We never thought that we could work as productively from home. There have been ship inspections which were possible. So the industry has to look at how the paperwork can be digitized. By paperwork, I mean, port calls, the documents required, the certificates, the bills of lading, and technologies like blockchain can be used. Then we have technologies like machine learning, etc. So there is huge opportunity to look at the digitalization part and digitize as much as possible so that we can manage processes easily. Having said that, one thing that I would like to highlight here is that with this comes a cybersecurity threat. So as we progress and start digitalizing more, we have to think of the cybersecurity aspect as well, which I see being spoken of less in shipping. And when we digitize things, we have more data. It gives us the opportunity to make better decisions. The next one is disruption. So, I would point out to like 2008, 2009, we had the financial crisis. So what we see is that shipping cycles are becoming shorter now. With shorter shipping cycles, this increases the uncertainty and the complexity. So the shipping industry will have to grapple with, like, the coronavirus. Nobody had foreseen anything like that. And then, the industry had to adapt to it rapidly. However, having said that, such disruptions create opportunities for trading and also earnings when the market is volatile. But the shipping will have to, contend with this. Lastly is deglobalization. As the pandemic came, the supply chains realized that there were shortfalls, there were gaps in the system, and they were not, resilient enough. So now people are looking at, the supply chains, and they are taking manufacturing elsewhere from where it was currently, so that the production is not disrupted. So shipping thrives on demand. Shipping thrives on more tons being moved on more miles. But with this deglobalization and the supply chains being reworked, shipping will have to look at very closely how that is going to impact over the next few years. On this point, I would also like to share that with this comes a little bit of a decoupling effect as well. What we have seen, in the past few years, we would have heard of the BRIC countries out of Brazil, Russia, India, China, and South Africa. China has been the greatest demand driver. And at some stage, when the Chinese economy matures, it is going to become less commodity intensive. And when it's going to become less commodity intensive, that means it will have to look elsewhere, or the manufacturing will move elsewhere. So the shipping industry will have to grapple with that when these shifts, the long-term shifts take place. And finally, I would like to say, in the words of Alfred Tennyson, the old order is changing, yielding place to new, and shipping presents opportunities just not in assets or shares. It presents opportunities in decarbonization, digitalization, and innovation is there to drive the industry forward. With that, thank you very much for listening, and over to Captain Verma.
Thank you, Captain Singh. What a fascinating presentation. I hope all our listeners have enjoyed it. We have a few questions for you. And the first one is, it's so simple to say shipping is supply and demand and shipping is cyclic. And we know how complex the demand and supply is. You have discussed ton miles, you have discussed various ways, the ship owners adjust slow steaming, laying up ships, scrapping. And I see a very interesting point that you said that the China has in changing to electric arc furnaces have increased the demand for scrap ships, which means indirectly the demolition industry will be put at advantage because ship owners see what is advantages. So can you give me more detail? What do you see the effect of the China on the scrap market, on the demolition industry of China using more scrap steel?
So as you know that we call it demolition, but as the right word is recycling these days. and with that, as long as the prices are competitive. So what we've seen is within the subcontinent, and with subcontinent I mean India and Bangladesh and Pakistan, where the ships are sent for demolition. The price is slightly lower than what it is in China. So when we come to that stage whereby the regulations are being followed, whereby the price that is being offered is right, I would see more and more of this heading in that direction. But it's ship owners are very sensitive to price. So at the same time, when they buy ships and when they sell ships, they want to see the dollar per ton return, and that drives where the ship is finally going for recycling. But definitely, it's one area which could see an increase.
Thank you. Another question that I have is for all of us. Something you talked about and referred was a negative price of oil. If you can explain what a little bit more on that for all of us who are not so familiar.
So the negative price of oil happened that in the US you have forward contracts. And forward contracts are that you say that you will take that much oil, but when you come to the time for delivery, you actually unwind the contract. Now, in this case, what happened is that the oil price started falling. And in Cushing, the storage level, because there was so much of supply, kept on increasing. So the shore storage was almost full. And we reached a stage whereby somebody had to almost default on a contract or get out of a contract, and that led to the sharp drop. Having said that, when you rolled over from May into June, the price went back up. So this is more of a sort of how should I say, a technical and a financial aspect, because you just, that's how the oil industry works, that you actually hold oil without actually physically taking delivery of it. And when the storage was tight, obviously you can't take delivery and you have to take a hit on the price.
All right. Okay. Thank you. We have a lot of questions coming in and we don't have much time, but definitely a very interesting question from Anu. Please advise if the deglobalization, would you see another cyclic drop in dry market?
Dry market currently, as I mentioned, the demand is driven by China. And unless we see, we seeing the second stage of the pandemic across, Europe and across America. So until we see the demand recovering elsewhere, we think that China is still continuing to, be the source of industrial production. So in the short term, I think not much, but in the longer term, yes, it will definitely change, because then the industrial production is expected to move elsewhere.
Okay, we have a stream of questions coming in, and the next one is from Leslie. His question is, the question is, do you see a price increase in LNG? I'm not sure whether Leslie is talking of freight or he's talking of the price increase in the LNG itself.
Yeah, I don't know. I sort of, the demand for LNG has been strong, but at the same time, with how the conditions are across, I'm not too sure that I can comment on the LNG prices. But yes, what we have seen is, in the current scenario, if you look at, the LNG side, the floating storage increased a little in the current scenario because, the demand across has dropped. So, unfortunately, I can't answer on the pricing front so much.
All right, thanks. And I think this is the last question is, you have given a very good detailed, ton miles, the supply, the demand side of it. Now we have, can you, I may be asking a very direct question. Can you predict how the freight rates are going to go ahead from today?
That's a good one. So I think in terms of freight rates, let's take sector by sector. On the bulk side, we see strong recovery in China, and that recovery is also because of the increase in industrial production, and also because of the stockpiling that has taken place. So you have limits to what you can stockpile. So there will come a stage, I think, and this could be part of the geopolitics as well between Australia and China. I think that will slightly dry up, and we have seen the number of deliveries and demolitions increase. So on the bulk side, unless there is recovery elsewhere, I think we'll see a slight drop in earnings, but it's still better. Now, looking at the tanker side, we've seen a strong fleet growth. We've seen very high earnings, but because of the lower demolition, because there was demand, there is uncertain recovery in terms of recovery of demand. So I think tanker side has a few tough months coming up because the floating storage is unwinding. The demand is not coming back because there are lockdowns happening across the region. So the tanker freight rates, I think, will continue feeling that pain, but they've gained much earlier. On the container side, as we saw that container side has recovered very well after the initial drop, and this is driven by the restocking demand for essential goods. Having said that, once we come towards the Christmas season, then obviously across the globe, when you see with the pandemic, there are people who are getting unemployed. That means it'll lead to consumer spending declining because people are going to be out of jobs and they'll just go for essentials like food, etc. So any other spending is going to be curtailed. So I think container side will see some drop off as well.
Okay, we have quite a few questions coming in, but I'm afraid we have run out of time. So thank you for your lovely presentation and for answering our questions.
Thank you. It's been a pleasure.
Thank you, Captain Singh. Thank you, Captain Varma. I would just like to remind everybody that the Nautical Institute is a membership organization, and we're very pleased that both Captain Singh and Captain Varma are associate fellows of ours. So it is open to all professionals. So if you would like to carry on with this conversation, if you would like to share your ideas and like to join the path of continuous professional development, please do consider joining us as a member of the Nautical Institute. So on that note, I will thank all the attendees. Thank you very much for your interest, and I will thank our speakers for attending. Thank you, gentlemen.
Thank you.